When you split your purchase into 4 payments with Klarna or Afterpay, you're not the customer. The store is. That's why they don't charge you interest. Most people think buy now, pay later is free money. You pay 0 interest, there's no credit check, and you walk away with your stuff immediately. But nothing in finance is actually free. The question isn't whether someone pays, it's who pays, and where that cost eventually shows up. BNPL exists because it solves a specific problem for retailers: abandoned shopping carts. When people see a $300 total at checkout, they hesitate. Break that into $75 4 times, and suddenly it feels manageable. Stores know this psychological trick boosts conversion rates by 30 to 50%, so they're willing to pay handsomely for it. That payment comes out of their profit margin, and ultimately, out of everyone's wallet, including people who never use BNPL at all. Buy now, pay later is a payment method that splits purchases into installments, usually 4 equal chunks spread over 6 weeks. You pay the first installment at checkout, then the rest automatically charges your debit or credit card every 2 weeks. There's no interest if you pay on time, no hard credit inquiry, and approval happens in seconds. Companies like Affirm, Klarna, Afterpay, and Sezzle operate this model. Think of them as sitting between traditional layaway, where you waited to get your product, and credit cards, where you pay interest. BNPL gives you the item immediately and charges 0 interest, which sounds like magic until you see the mechanics. Here's how the money actually moves. You're buying a pair of sneakers for $100. At checkout, you choose Afterpay and agree to 4 payments of $25. You pay the first $25 right there. The BNPL company immediately pays the merchant the full $100 minus their fee, which typically ranges from 2 to 8%, depending on the merchant's size and negotiating power. Let's use 6% for this example. The merchant receives $94. You make your remaining 3 payments over the next 6 weeks, $25, $25, $25. That $75 goes to the BNPL company, who already fronted the cash. At the end, you've paid $100 total, the merchant got $94, and the BNPL company pocketed $6 without charging you a cent in interest. The $6 gap is what funds the entire operation. Now compare that to a credit card. When you swipe a Visa or MasterCard, the merchant pays around 2 to 3% in processing fees, and the card network doesn't take on default risk. If you don't pay your bill, that's between you and your card issuer. The merchant still got their money. With BNPL, the fee is double to quadruple that amount, and the BNPL company absorbs the default risk. If you disappear after the first payment, the merchant has already been paid in full. The BNPL company eats the loss. So why would any rational business accept a more expensive payment method that also shoulders more risk? Because it drives behavior. Studies show BNPL increases average order value by 20 to 30%. People buy more expensive items or add extra products when they can split the bill. A shopper who might have bought $50 jeans suddenly feels comfortable buying the $80 pair. For retailers operating on thin margins, that bump in cart size and conversion rate offsets the higher fee. It's not charity, it's calculated math. This creates a hidden subsidy loop. Let's say a brand starts offering BNPL and their fee is 6% per transaction. To protect their margins, they have 2 choices: accept lower profit on BNPL sales, or quietly raise base prices across the board to absorb the fee. Most choose the latter, especially in competitive categories like fashion and electronics, where everyone offers BNPL now. If a retailer used to price sneakers at $95 and clear $10 profit after costs, and now they're paying $6 to the BNPL company on that sale, their profit drops to $4, a 60% margin cut. So they raise the price to $100. Now their profit is back closer to $10 on BNPL purchases. But here's the kicker. That $100 price applies to everyone, even customers paying with cash or debit who generate 0 BNPL fees. Non-BNPL users are subsidizing the installment option for BNPL users. It's a hidden tax baked into the price tag, invisible unless you know to look for it. People assume BNPL companies lose money on defaults and make it back through late fees. Reality is more nuanced. Default rates in BNPL hover around 2 to 5%, much lower than credit cards, because the amounts are small, the timeframes are short, and users who miss payments get cut off from future purchases immediately. Strong behavioral incentive. So if a BNPL company charges 6% to merchants and loses 3% to defaults, they're still clearing 3% profit per transaction without charging consumers interest. Late fees exist, often around $7 to $10 per missed payment, but they're not the primary revenue engine. They're punitive friction to keep people paying on time. The real money is the merchant fee multiplied across billions in transaction volume. A firm processed $15 billion in gross merchandise volume last year. Even at an average 4% take rate, that's $600 million in revenue before operating costs. Zero interest isn't generosity, it's customer acquisition. Once you're in the ecosystem, BNPL companies upsell you to longer-term financing with interest, push you toward their co-branded credit cards, or sell your purchase data to advertisers. The free installment plan is the gateway drug. The biggest misconception is that BNPL is totally separate from credit. It's not. When you miss a payment, many BNPL companies report you to credit bureaus, which tanks your credit score just like a missed credit card payment. They also increasingly do soft credit checks at sign-up, and some require hard pulls for larger purchases. The no credit check pitch mostly applies to small transactions under a few $100s. Another confusion. People think BNPL is only for people who can't get credit cards. Actually, 60% of BNPL users have credit cards. They just prefer the psychological comfort of fixed installments and zero interest. It's a budgeting tool more than a credit substitute. Third misconception, that merchants love BNPL unconditionally. They tolerate it because competitors offer it. Privately, many retailers resent the fee structure but fear losing sales if they drop it. It's a hostage situation disguised as a partnership. Here's where the simple story breaks. BNPL works smoothly for low-ticket consumer goods, but it gets messy with returns, chargebacks, and high-value items. If you buy something with Afterpay and return it after making 2 payments, the refund process can take weeks, and you might still owe installments while waiting. If you dispute a charge with your bank, the BNPL company can freeze your account across all merchants, not just the one you had an issue with. On the merchant side, BNPL fees scale with purchase price, so a $2,000 laptop might cost a retailer $160 in fees at 8%, eating up most or all of the profit margin. That's why you'll see BNPL offered selectively, available on high-margin jewelry, unavailable on low-margin electronics. And if a BNPL company goes bankrupt, which hasn't happened to a major player yet but remains possible, it's unclear whether consumers still owe installments or if the debt vanishes. The contracts say you owe the full amount regardless, but enforcement in insolvency is a legal grey zone. Buy now, pay later is a payment method that lets you split purchases into installments without paying interest, funded by merchant fees that typically run 2 to 8% per transaction. It exists because retailers discovered that breaking prices into smaller chunks dramatically reduces cart abandonment and increases order size, even though it costs them more than traditional credit card processing. The system prints money by charging merchants a high fee, keeping default rates low through short repayment windows and instant account freezes, and treating zero interest installments as customer acquisition for higher margin financial products. The cost doesn't disappear. It gets embedded in everyone's prices, meaning shoppers who never use BNPL are subsidizing those who do. When someone tells you a financial product is free, they're not lying. They're just not telling you who's paying or where you'll find the bill later.